Hello and welcome to another episode of the Investing with IBD podcast. It's Justin Nielsen here, and I am not joined again by Arusha Paris. He is off for most of this month, actually, but that's okay because we've got a great lineup of special guests to still entice you with some great summer loving fun. So today we have Kathy Donnelly. She's a prop trader and co-author of the Lifecycle Trade. So welcome back to the show, Kathy. How you doing?
Thanks, Justin. Yeah, it's great to be here.
Always awesome to have you. I mean, Kathy and I go, we go a ways back. I've spoken at a few of her meetup groups that she was doing. Are you still at the Denver library or?
Actually, we've been virtual ever since COVID.
Virtual ever since. Okay, yeah. So it's been a while. It's been a while. So, and of course, Kathy and I met originally, I think, at probably a level 4. Where she came to watch Bill speak and watch a number of our portfolio managers talk about how they do their investing, and she was just one of those people that sat down and took a lot of notes. And of course, you have to kind of make this your own, and she certainly has. There's a lot of things that she does that are a little bit differently, but she has success at it. So we want to have opportunity for our listeners to kind of hear about your success, Kathy. But what we're going to do later on in the show is we're going to kind of take one of your 10 baggers, because that's kind of the goal everyone has, right? One of those stocks that you can have an increase of tenfold, because those can really make a big difference in your portfolio, especially if you have some size in them. So we'll get to that with your 10 bagger. But first, why don't we go ahead and talk a little bit about the market and kind of get your thoughts. But before we do that, I just kind of want to, feel you out a little bit. How much attention do you spend on the market indexes and analyzing what's happening with the general market?
Oh, I spend a lot of time. I mean, maybe not as much as others, but I definitely look at it every day. I kind of want to see the trend. What's the 4 to 5 day trend? Is it trending up? Is it trending sideways? Is it starting kind of a downtrend? Because I feel like every 4 to 5 days, right, we're going to see that change. And so it kind of prepares me, okay, it's going sideways now. So that means it's either going to go up or down, or is it edging up? And obviously right now we've had quite a few days up. So as you guys have already been pointing out on your great stock market today, is that, we're extended. And so I don't know what's going to happen next, but we're definitely either going to be going sideways or down soon. So that might be a little scary, but we're prepared because we know what to look for in our stocks, and ultimately that will guide us. But it's very important, I think, to know where the markets are, because then you can also see how your stocks are responding in comparison, and if you want to make adjustments accordingly.
Yeah. Now, it kind of surprises me that you say that you kind of look at the 4 to 5 day trend, because I admire you for your long-term perspective, and 4 to 5 days just seems so short.
Yeah, well, I mean, that's for the market. I'm not doing the 4 to 5 day in my stock. So yeah, I should probably clarify that. But in the market, I am, because if I know the market's going to start correcting, then I know my stocks are going to start correcting too. And then I want to know what those levels are going to be as well, and just be more prepared.
And do you make any adjustments? Do you do any selling into strength when you see the market get extended, or is it just, again, kind of more tightening your stomach because the punch is coming?
So this is a funny story. So I am classically never sell offensively into strength, except for CrowdStrike, when it had the railroad tracks not too long ago. I mean, no one even talks about the railroad tracks anymore.
It's been a while.
So, I looked at some examples. I read some old IBD articles on railroad tracks, and I even had ANET way back in the day, and it had railroad tracks. I held it, went into earnings exactly like what CrowdStrike did, reversed, and then I ended up selling ANET. And so this time I'm like, I'm going to be proactive, and I'm going to sell it ahead of time. And I haven't gotten back into it because the examples that I looked at of railroad tracks, on IBD, you can search for railroad tracks and you can see a bunch of articles of ones that you've written on it, where the stock really didn't do anything after railroad tracks. So I keep waiting for it to not be going up.
Yeah.
Kind of funny. And I was like, geez, the one time I sell offensively and this is what's happening.
Yeah. So just to make sure I marked up the right railroad tracks that you were looking at.
Yeah, it was right before earnings. Yeah.
Yeah,
And
right before earnings. So of course, one of the things that happened, just to kind of identify this time period for folks, this was in February, beginning of February. And the way we look at railroad tracks is you basically have typically a wider spread. This is something after a stock has been running. So we definitely had that with CrowdStrike, because I mean, if you look at from the bottom in November of 2022 or the end of 2022, it had been in this, major uptrend. So you really want to be identifying railroad tracks kind of for a move that has matured a little bit. And specifically what you're looking for is 2 weeks. This is something that you look for on a weekly chart. And what happens is they kind of retrace. The first week will be strong. The second week basically retraces most of the first week. And Bill just called that, it looks like railroad tracks. And a lot of times you'll find that, the hash marks might, close around the same, area, but they don't have to. But it's mostly that retracement that he kind of believed was, okay, this is a stock that is still having price discovery, but not making progress. And a lot of times he saw that in conjunction with maybe climax tops and the like. But as you mentioned, this was in February. I'm going to go to the daily chart on this. And almost immediately afterwards is when this big drop happened. Of course, this was from Palo Alto earnings, PANW. Palo Alto dropped significantly. It was down, 28% by the end of the day. And CrowdStrike held up much better. And as opposed to plunging through the 50-day moving average line, it got support there, but was still down 10%. It had this earnings, as you mentioned, where it went up 10%, but well off its highs for the day, and then did this long base. So, I just wonder, Kathy, I'll be honest with you. I think a lot of times we'll choose railroad tracks for our articles that might kind of show a little bit more devastation afterwards. So we might be cherry picking our examples. So you might have to do a little bit more research on your own and not just rely on the ones that you've seen from us. But
it's funny. Let me just jump in real quick, because with the How to Make Money in Stocks book, Bill has several examples of railroad tracks, and he says sell all. So I looked at those as well. So anyway, it's all good, but it's just funny that you asked me, because that's the one time I sell defensively, and that was the ending of the week of the railroad tracks.
Yeah, and it is a good thing, because usually you do see weakness. Now, in the case of CrowdStrike, this one did come back. It made a full base, which, hey, I don't mind when I can sit out of a base, because bases sometimes can be a little bit harder to hold through, especially if you don't have much cushion. But I assume that you had a nice cushion in
I did. I bought it that first stage base as it was coming off the bottom there. And so, I had a pretty nice cushion that I would have held through the base had I not seen the railroad tracks. But this is how we learn. So,
well, and again, I don't think there's any problem with that sell right there. Yes, it is at a higher price now, but locking in that kind of gain and sitting out months worth of inactivity is not bad. But getting back to the market, you mentioned how you've been watching SMT videos, and we've been talking about extended. But of course, one of the things about a market that's extended is you can certainly get extendeder, if that's a word. So I feel like that was kind of what happened today. We were up 1%. Yesterday didn't quite fit the bill for stalling, but it did look kind of like it. It did qualify for the S&P 500, as a stalling day. But both of them were up over 1% today. So do you typically just say, look, I'm gonna ride the strength for as long as it lasts, and then be prepared to look for sell signals on the downside?
Yeah, I mean, I think what's important is like newer positions, right? So the newer positions that maybe I only have a 5%, 10% cushion, that's really what I'm looking at. The ones that I have that I've had longer term, which, we're going to look at, that of course, is going to have a different perspective. And I'm not looking at it from that shorter term perspective of what the market's doing. But if I have like a new cup with, buy point from a cup with handle, and don't really have any gains, then I may not want to hold on to that, especially when we're extended like this.
Yeah, very good point. Now, what about some of the positions that you do want to hold on to? Do you ever do any type of hedging? And I know we'll probably get to this a little bit in the next segment, but just as a preview.
Yeah, no, it's a great question. And no, I don't hedge at all. I never learned to hedge. When I was learning what systems was going to work for me, and I found IBD and Can Slim, Bill didn't teach hedging, so I didn't learn it. Now my co-author, Eric Kroll, he's very good at hedging, and I've listened to him and he showed me a few things, but I just stick with what I know. So no hedging.
Yeah. And look, if it works, why mess with the system, right?
Exactly.
What about the small cap market? This is something that a lot of folks have been, looking at as, it's had this level at 2,000 that has been kind of sticky. It just seems like it gets above it for a little bit, then it goes below it, gets above it, gets below it. Does this get into your equation at all? Because the Lifecycle Trade was a lot about IPOs, and a lot of them are kind of the newer companies in that small cap universe. Does that ever, do you ever spend a little bit more time on the Russell 2000 because of your IPO focus?
I mean, that's a great question. And obviously, yeah, the mega caps, the bigger names have been doing well. And those are the ones that the market's giving. So those are the ones that I'm purchasing. But for me, it's really easy to keep tabs by just looking at market liquidity. So, taking that 50-day average volume, multiplying it by the price. And if I get that, 20 million is my minimum, prefer 100 million or more. And I just watch them from that perspective. And there's several that are in these long institutional due diligence phases. And we'll look at some at the end. And they just keep building base after base because they just don't seem to be in favor. So hopefully at some point they will be, and we'll have some runs from there. But until then, we'll just keep our eye on it.
Sounds good. Well, we're going to go ahead and take a break. And when we come back, we're going to have a little bit of a longer segment on how you handled your 10 bagger and what you're looking for the next one. Stay tuned. We'll be right back. Welcome back. It's Justin Nielsen here on the Investing with IBD podcast with my special guest this week, who is Kathy Donnelly, a proprietary trader. Kathy, what does it mean to be a proprietary trader?
It means I trade my own money.
Okay, just that simple. Should also mention that you are a co-author of the Lifecycle Trade. This is the book that a lot of our readers have really enjoyed, because you and your co-authors, many of whom have been on the show as well, including Eve Bobach, Eric Kroll. We haven't had Kurt on, but say hi to Kurt for me next time you talk to him. But yeah, you guys really kind of just went through and looked at a lot of different things, especially with the IPOs and how they mature. What it takes to kind of get as much money out of them as possible. And so that's what you're really all about, is trying to get as much money out of a stock as possible. And what got you kind of interested in that?
Well, you mentioned the level 4 workshops back in the day. Once I got hooked on the system, I pretty much went to every level 4 I could. Yeah. And luckily you guys started, unluckily, you started doing them only once a year. So I wasn't going to 2 a year, but I did once go twice in 1 year. But anyway, basically that was the premise. I would go to level 4 and you would show all these great stocks of the year, and you would show like the first stage base and these huge runs, and then showing the end where that's when you would sell it. And I was just like, that's what I want. I mean, 20% is great. And I know that's what a lot of stocks will give us, but there are those really great ones that will create the first stage base, go all the way to the fourth, maybe reset and keep going. And that's what I wanted. That was my number one goal. So I was able to definitely implement long-term trading for me, many 100% over my career, thank goodness. And now my first 10 baggers. So I've definitely got some new tools in my toolkit, and maybe I can apply it to some other stocks. But definitely you've got to have that N in Can Slim for sure. It can't just be any stock, right?
Right. And that's an important part of, recognizing that you can't treat all stocks that you buy as, oh, this is automatically going to be a 10 bagger. I personally had a conversation with Bill one time, and we were just going over some of the stocks that were in my portfolio. This was like 25 years ago, and he kept on asking me why I wasn't selling any of them, because I had good gains on them, and I kept on saying, well, because I think that this is going to be a great stock market winner. And he's like, why do you think that every stock that you own is going to be a great stock market winner? Like, you're not that good. You just started, kind of thing. And so I had to kind of, recognize that, and again, this was from Bill. Hey, some of these are going to be your smaller gains, your 20 percenters. And then when you find something special, that's the one you treat differently. So how do you kind of approach it? Are you treating everything like it could be that big stock market winner, or do you go into some saying, yeah, this one probably isn't, but I'm going to give it a try and just see what develops?
Yeah, well, I mean, I'm always looking to purchase at that first stage base. And I think you and I did a podcast on first stage bases.
Yeah.
A while, I don't know, a couple years ago or whatever. And
time all blends in together, right?
Yeah, the time blends in, but I'm always looking for those first stage bases. And then the stock has to guide me, if it's, if we get that 8-week hold rule, if it goes up 50% or more, before that next second stage base, if the stock only goes up 20% and then starts to correct, well, okay, that's not going to be the next one. But you have that stock like CrowdStrike we just looked at. I mean, that first stage base was excellent. And that could have been one I could have kept holding, like I said, except for I saw the railroad tracks and we're trying to, be offensive. But as we'll look with Nvidia, same thing. There was a lot of distance, a lot of percent change in more than 50, more than 100 in some cases between bases, so that you could then apply long-term trading strategies. Right. And so that's what, that's how I'll be able to decide which ones I'm going to hold for that long haul. And, if the market, now that it's extended, it's really going to show which ones have that, that matter, the ones that are going to withstand and keep going or not.
So in order to get a 10 bagger, and this is something that people have to realize, is in most cases, that means that you're going to have to sit through some bases. You're going to have to sit through some pullbacks. It's not like your metal will not be tested. That's just not the way this game works, right? So do you, typically, we're often selling quite a bit when there's a bear market. Are you holding, through bear markets? At what level do you say, okay, nothing's working right now, I've got to raise more cash, and that might include something that you think has great potential, but just might be in a corrective phase now?
Right. Well, the situation, you have to have the right situation. So the situation was pandemic bear, 2020, everything was going down. Everything was below like their 40-week moving averages. And then we had a quick pandemic bull. So it was like, okay, which are the ones that are moving quickly on strength, and which are the ones that should I go into for really holding on for the long haul? And that was my mentality. So I was like, okay, Nvidia has been a great stock for many years. It's still in the AI space. It's still having that new. And if there was a time to get into Nvidia, like, to me, that was already in my head, like, okay, this is the time, because everything is just corrected, Nvidia included. Let me get in there now and let me try and hold it for as long as I can. That was the setup. And so you have to have all the pieces coming together.
Right. And so I'm pulling up a monthly chart right here, and I'm pointing to, again, the pandemic bear market was really just 1 month, right? It was March.
Right.
We were at highs in February. March was ugly. And then we had the follow through day at the beginning of April. And by May, we were back to highs. Now, Nvidia.
You had to be quick.
Yeah, Nvidia had this, it had been basing for a while before.
True.
I owned this, back here, and I do need to disclose that I do own a small position in it still. I actually sold a lot of it, because I had like a 25% position. So I sold a lot of it after the downside reversal not too long ago. But I did have some of it. I think I was selling in here in 2018, and I might have bought it back a couple times in here, but yeah, it was in 2020 that I kind of went back in with size. So let's go ahead and we'll go to the weekly chart to kind of and I'm going to change the scale on here. I know that Mike Webster would, be like, oh, how could you? But sometimes we use this best fit scale just so you can see stuff. And actually I'm going to.
Well, that's the base right there on the left, the one I bought anyway.
Yes, right here. Here's March 2020.
If you want, add the index line to the chart.
Okay.
That would be helpful.
Let's add that. So here it is on the top. So you can see the S&P 500 coming down very sharply here, as did Nvidia. But one of the things that you'll notice, the RS line was really strong as it, and look, it was a quick snapback, and you actually had kind of this cup with handle look to it with Nvidia. So you were buying right in here, I assume.
Right in there. Yeah.
Okay. And so now kind of walk us through, there was this period here where it didn't do anything for a long time. So what are you thinking to yourself during this time?
Right. Well, again, my mindset for the first purchase was just buy it once, and then this is going to be long term. I wasn't really thinking of it as the stock that it is like today in the last year, how quickly it's moved. I was just thinking of it from a long term perspective. But what has really made a difference for me in my long-term trading is what we called in the book, the Lifecycle Trade with my co-authors, is the mental capital preservation, which is really just three big words. That means how much gain do I want to retain? And so for me, like, in general, if I have that 100% stock that I've told you that those are my goals, to have 100% in a stock, I want to retain at least 50 to 60% of my gains. And anecdotally, in our research, we're like, well, how much gains would you need to retain for like a multi-year great stock? And we said, well, maybe 35. So we never tested it, but in the back of my mind, 35 was what I was using for Nvidia. So no matter how much it went up, I was going to retain at least 35% of my gains. So I wanted to give it the most possible room so that I could hold it, because we did have examples of Tesla and Amazon and Facebook that went, hundreds of %, and you could have used MCP 35. And even at 35 with a $100,000 investment, you could still have like an enormous change in your portfolio and in your life with just that. So we did know it was possible with those great big stocks. And so that was my mindset going into it. So when it was basing in those three bases that you talked about, the deepest one of those three, it was like a 3 bases in a row, was 25%. And I had enough cushion to sit through that. I mean, you can clearly see that on the chart. There was a lot of space. So it didn't really faze me because I knew where my line was, and I knew going in how much room I wanted to give it.
Okay. So, you know what? And let's go ahead and just talk about the formula real quick. So, no one promised you there was not going to be any math here. So we'll just kind of do this formula real quick. So you got the buy price plus your peak price minus the buy price. So that's basically what kind of appreciation you had at the top, right?
It's just the gain, right? Yeah, it's just the difference in price from the peak to this. So it's just the gain that you got, and then you want to multiply it by whatever percent gain you want to retain. So if I want to make sure I always retain 50% of my profits, you multiply it by 0.5. If I want to retain 35%, I multiply it by 0.35. And then that gives me the price. That's my stop loss for whatever retention I want to keep. So unlike Justin, I'm giving you the math. You don't have to do it unless you want to. And this is an inside.
Hey, that was Webby. Don't blame that on me.
Yeah, the most recent other podcast.
Yeah.
And then, go ahead.
Oh, well, I was just gonna say. So just to put some numbers on it, like if you bought it at 100, and let's say you got a double. Okay, so this is awesome. I got a double. You made 100 points on it. That's what a double would be for $100 stock. You're up to 200. So of course, 200 minus your buy price of 100 is the 100 profit that you have. multiply that by, 35%, that's going to be 35. So basically 135 would be your thing. Okay, let's go ahead and we're going to go to the chart and see how this math kind of worked out, for you. So back to Nvidia, we had, just from here, you went from, as you said, a 675 was that where you said your split adjusted buy was, to, 14?
Right.
And some change.
So that's right in line. That's right in line with once I have 100% gain, I want to give it at least a 50% or 60%. I want to retain for a normal stock, for a stock that I'm not going in with the long haul. That would still be enough for me to hold it from that perspective too, where I'm retaining only 50 to 60% of my gains too. So I just wanted to point that out, that even with my pseudo not longer term strategy, but still long-term strategy, I would still be holding it through that base as well, because I already had 100% between the first base and then these next bases.
Okay. So, one of the things that during the time it was doing these bases, it spent quite a bit of weeks below the 10-week moving average line. But a lot of times you're kind of looking at the 40-week, and it looks like the 40-week actually ended up giving Nvidia support at that time.
Right, exactly. And then, the other thing I want to say about is Nvidia's. Now, granted, past performance is not indicative of future performance. But Nvidia has done this before. I had never owned Nvidia before, but I studied it a lot because I was like, why didn't I buy it, when it had that first run from, back, I don't remember what year it was.
Yeah, 2016 to 2018 was phenomenal.
Exactly. So I watched it for a long time, and it did what it did in that those three bases we were looking at is done that before, where it just kind of consolidates tightly, 20%. I don't know if you consider that tight, but that's pretty tight, not 30, not 40, not 50. And then it will do like a base on base and then a base reset. So I also had that in the back of my mind. Like, what has Nvidia done in the past? And how can I use that as information to give me a clue of what it might do, this time? Is it going to be similar? And is it going to be in character or out of character from its past history?
Now let's go ahead and fast forward a little bit back to the present for not the present, but the recent present, I guess. You came out of that area back to highs. It was looking good, and then we have basically a lot of stuff started topping in February of 2021 in terms of the growth stocks, and then of course 2022 ended up being a full-on bear. So split adjusted prices, because remember we had this 10-for-1 split here. But we were at all the way up to what, 30, almost 35, and came down to $10.81.
I had a 427% gain at that peak.
Okay.
And then it went down about 69%. Okay. And at that very low, I only had a gain of 64%.
So 427% gain down to 60
and
change. Okay.
Exactly.
So here was my mindset. How do you deal with that psychologically, Kathy?
Yeah.
I'm trying to understand, because I'm just imagining that in myself, and I would just be like, kicking myself. Right. I had it, and so much of it is gone. So how do you do that?
And I should point out, at that point too, it was actually a 15% retention of gains. If I had sold it at that point, I would have only retained 15% of my gains, which is really interesting when you think about the math, because it's like, wow, you only retained 15% of your gains, but it was still 64%. Overall. The math is just crazy. But again, my mindset was long-term, and I had a feeling that, it was going to potentially undercut that structure of those bases that we looked at. And then I also knew the market was, had the 3 waves down. Nvidia had the 3 waves down. Maybe I had a chance here the market was going to turn. But again, my mindset since I am a long-term trader, and being a long-term trader, you have to withstand big drawdowns, but then also the potential for big gains. So my mindset is I'm always retaining gains. So if I'm always retaining gains, I'm always making money.
Right.
So it was worth it to me to give this because I still wasn't negative, and it wasn't my money anyway, because I hadn't made the sell.
You were playing with house money still.
Exactly. So the risk and the value of the potential of what could happen was worth it to me.
Now, let's talk a little bit about position size, because, if you were very heavy in this and you had a 65% drawdown in a very large position, that would do quite a bit of damage to your portfolio. So what position size do you typically have in order to kind of withstand that kind of pressure?
Right. So this was a 10% position size. And I guess when, back in 2020, the way I was looking at it, as like you, I have multiple accounts that I trade, and I have, I guess, two main ones. And basically I had an amount of money in this one account that was 10% of that account plus my other active growth account. And I was just like, I'm just going to put all this money in that stock, which was the 10%. And again, it was for the long haul. So from that perspective, again, I guess it didn't faze me, because it kind of was an active account, but it wasn't as active as my other account. So I was okay with what it was doing. And I did, again, I'm just looking at it from the retention of gains.
Yeah. Now, I like what you did here, where you were looking left, you were looking at this area, noticing, okay, a lot of congestion here. So what were you thinking when it undercut this? Were you like, uh-oh?
I was definitely nervous when it undercut the structure, for sure. And actually I calculated it. It undercut it by 6.5%. And I mentioned to you that I looked back to what it had done, and I believe you said 2016. And in that case, it actually didn't undercut its previous long basing structure that it did in that time. But I knew, that there was going to be some congestion. So again, my line in the sand was going to be a 30% gain. So I still was going to give it more room. And then again, but I also had the 3 waves down helping, and I just was like, okay, I hope it turns around. But I had my line in the sand at 30% gain, which I know seems crazy to most people. But again, it was the mindset and the thought that I had that just kept me on that path, that if there's any stock I can do this with, this is going to be the one. Yeah.
So we bottom out, and now, we turn around, and Nvidia has a phenomenal, 2023. Now, this was a stock that you really didn't add to along the way up, as you got that 400%, gain.
Right.
When do you add? When do you say, okay, I'm okay, because it's tough, especially if you're up 400% on the stock, you're going to be having that, unless everything is up, that's going to become a larger weight in your portfolio just by the capital appreciation. So you have to be careful of adding too much, because then again, you could get to that portfolio size where a drawdown like that is just, so uncomfortable, you sell out at the lows. So did you do any adding coming out of this bear market?
Well, I want to say that I think if I hadn't had the mindset in the beginning that there were going to be no ads and this was a long haul, I probably wouldn't have been able to do what I did. But now it's reset. And now I've got a brand new first stage base after a bear market.
Right.
So I had to buy. And I remember a story that Bill told me that, he was telling me about Apple, and he was like, we made all this money in Apple because it just kept making more bases after bases. And we just kept buying more and more and more. So I actually had that in the back of my mind when Nvidia reset and created this first stage base. And I was like, well, okay, it's given me an opportunity to buy more. So now I have a new position, and I am treating them independently in another account, my more active account that I mentioned. And yes, so now I have 2 positions in Nvidia, but I treat them independently from that first stage base. And I'm treating it now as an active growth stock versus a long term for the long hold. So I've been adding on the way up on this one. So like there, and then some in that basing there. Yep, exactly. So what I'm thinking moving forward, based on what I've learned from my 2020 NVIDIA trade, is that if I'm going to hold now this position, this new position for a long-term hold, if it's possible, if NVIDIA continues with that N and Can Slim, most likely I'm already thinking ahead. I'll probably have to cut all those ads at some point, take the gains, and only hold the core again, like to make it similar to the original 2020 NVIDIA trade.
And so when you say the core, do you mean kind of like this initial position?
Base. Yes.
Yeah. Okay.
Exactly.
Yeah. And look, again, that's something I can definitely get behind because, as we said, that can become such a large percentage of your portfolio that it becomes, again, I know you're brave, but wow, being that brave would be tough, to have a large position and take that kind of drawdown. So, so going forward, like at what point now, I'm going to go back to the monthly chart here, Kathy, because, NVIDIA had this phenomenal move from 2016 to 2018. It already achieved model book status at that point. And then it had another great move from 2020 to that 2021 top. And now it's, kind of in model book, territory again. So with these multiple already model book stage moves, at what point do you say, gosh, NVIDIA, I've gotten enough from you. You've done your job. How do you prevent yourself from getting too greedy?
Well, I mean, I think that's a great question. And, greed's an interesting thing because if I'm trying to get more money, it's only at the expense of the money I've already gained, right? Yeah. So when I think about it in that way, again, it's about a retention of gains. So I'm just going to go back to my rules and what I've learned in my methodology. And what I want to do is just start back with the very basics. Is like, okay, well, if NVIDIA's story is still there, I'm going to start with the 35 retention of gains. I'm going to look left. I'm going to just do all the same things that I did before. And really, there might be a time, but it could also turn into, the next Microsoft and just chug along slowly at some point too, which would be fine also. So, it's hard to answer a question in the future, but these are some of the things that I'm thinking about.
Yeah. And okay, you bring up Microsoft, so I'm going to, challenge you again here a little bit, because Microsoft was certainly, if you go back to, 2000, it had this phenomenal move. And of course, this was the operating system, starting with DOS, then Windows 95, and everything, else that, was so critical for bringing PCs to everybody's, office, home, and everything. But then, you look at what it did for 15 years, it was dead money. So, do you ever have like a time limit on things? Like, okay, if it hasn't, it certainly came nowhere near like a 35% MCP here. It really did retain a lot of those gains from the 90s, but gosh, it just didn't do anything for so long. Do you ever like put a time limit on things?
I mean, I would definitely put a time limit. Where's that? Oh, go back to the where you were.
So here's the 2000 top.
Yeah. Okay. And where is that? What year is that other little V there in the middle?
Right here?
Yeah.
Yeah. So that was the financial crisis, the 2008.
Okay. And then where's 2020?
Here's 2020.
Oh, okay. It's right there. Yeah, okay. So what I can tell you is with the financial crisis, I mean, I probably wouldn't, if I had held it, I don't know for certain. We'd have to look at the numbers and everything, but it doesn't look like that'd be something that I hold. But I'm glad you highlighted the 2020 because let's just do the example that I mentioned. Microsoft was another stock that I bought in 2020 along with Nvidia that I said, okay, I'm going to buy this one for the long hold. And I guess maybe it's just because, my parents were value investors. So in the back of my mind, it's a dividend paying stock. Like, it's nice to have these other ones in your portfolio doing things when the active big growth stocks aren't doing anything. And so this one I've also had since 2020. I clearly don't have the same amount of gains as I do on Nvidia, but it's a nice to have in the portfolio that has a dividends. And, you've got the long-term leader list that you have on IBD. And so I'm just trying to catch some of those along the way too. And they're just, nice to have with little volatility that you can kind of hold on to. So I guess, you hear this a lot, and I can't believe I'm going to say it too, but when you get a little bit older, you want to have some other little slower moving stocks,
little slower things, right? Yeah. you don't need to swing for the fences every time.
Right. Exactly.
Man, and yes, it's interesting you bring that up, because yes, Microsoft does have that earning stability. Low number is better, or more stable, I should say. Not to put a value judgment on it, but lower number is more stable. So 6 with an EPS growth rate of 20%, that does put it in that long-term leader category, especially with something that's able to outperform the S&P 500. And you see that with the earnings line. Last question on Nvidia. Let's go back there. The earnings line does not look the same as Microsoft. This was, it was a little bit more lumpy. There was, in fact, when this turned around here, you had some red numbers, yes, you were still positive, you were still, profitable, but the growth was just not there. And some of these, negative numbers are pretty big,
Well, I'm glad you brought that up, because, and I think many people that you've interviewed, you guys have said it yourselves. I mean, the stock, and even Ropel, he always talks about, you got to sit through so many beat and raise quarters. Well, at a certain point, it's extended even from their earnings. And so they have to kind of get knocked back down a little bit so then they can beat them again. So, that's part of it.
Yeah. And certainly one of the things I think, people were looking at with some of the phenomenal earnings growth that came, it was like, wow, it keeps on going up, but the PE is actually not. It's getting better because it's just, the earnings were growing at such a rapid clip. Well, hey, Kathy, again, this is where I'm grateful, because it's a learning experience for me on how you do this, how you're able to do this, because personally, my number of 10 baggers is still 0. And even my triple digit ones, I don't get triple digit gains that frequently, because I'll be in and out. A lot of times I'll, buy something, I'll sell it and then buy it back. And, even with Apple, for as much money as Bill made on it, there were a number of times I heard him say, yeah, I think Apple's done. And he was completely out. But then he changed his mind a few months later and said, oh, here we go. It's back to the best thing since sliced bread. So
right, exactly. And actually, that's another one. That's another one I purchased, I hope, for the long haul. And then, it wasn't working. I sold it, but now I'm back in it. So there are exceptions, and you just got to be paying attention and do what works for you, and have that, post analysis and experience, so you have those tools in your tool belt.
One more thing that I think is very important that we just stress here: these were first stage bases that you were doing this out of.
Yeah, first stage bases.
Yeah, so this is not something like you're buying it up here and saying, oh, let me get this 35% MCP. Here you're really kind of looking at these first stage bases.
Right. I mean, basically anything under a 50% gain, you're following the core rules of taking your 20% when you can get it. Maybe you can get 30%, but once I get past that 50%, I'm in that 100% category, then I'm implementing the first stage, the first step of my long-term rules, which is the 50 to 60% retention of gains. Yeah. Now that I have the experience with Nvidia, if I feel like I have a stock that could do more for me, most likely then I'll be selling those add-ons from in that 50 to 60 retention of gains area, and then holding on to that core. That's what I'm thinking for moving forward. And now with Nvidia, with the original shares from 2020, I'm going back to, okay, what's the 35% level, which is going to be around $50, right around where that current, again, those weeks right in there. Yep, exactly. So it's going to be interesting to see what it does, because again, we just saw that, and it's still on your chart to the left. It likes to consolidate. And then it might come back to it. It might undercut it. It might not. So that's what will be interesting to see what happens next with this one. And those are the levels I'll be looking at for those original 2020 shares.
Awesome. Well, thanks for sharing this. And when we come back, we're going to talk about some stocks that might be in those first stage bases that Kathy looks for. So stay tuned. We'll be right back. Welcome back to the Investing with IBD podcast. Justin Nielsen here, and my special guest, Kathy Donnelly, co-author of the Lifecycle Trade, along with some of our other former guests and probably future guests, Eric Kroll, Eve Bobach, Kurt Dale, of course, was in that group as well. But one of the things that you did with this book is really kind of focus on how a stock starts, from its IPO to what you call the due diligence phase, that institutional accumulation, all of these different phases. And so maybe we could kind of share with our listeners some of the stocks that you're looking at right now. I mean, there was kind of a paucity, if you will, of IPOs to look at for a while. We had such a strong SPAC and IPO market leading up to 2021. And then it was like the hose just went to a trickle, or a kink in the hose. There was nothing coming out. But now it seems like it's picking up a little bit. What do you think?
Yeah, I mean, there's a few more out there, not as many as I would like, for sure. But I would hope with the market that we're having, if it continues to, go up and do well, that we'll see more. I think Eric looked at some numbers a while ago. He might have shared them, I think, on IBD Live or on the podcast, about how the number of IPOs kind of lags because they want to make sure the market's good before they kind of come out. So I guess we'll see. But yeah, it would be nice.
Well, and again, remember with the IPOs, they're trying to get the most money that they can for their offering. And so it does make sense to not be the first, to stick your neck out. It's like more, oh, okay, let me see that I'm going to get the money that I want, or maximize that. So let's go ahead and start with Reddit. Of course, in the investing world, Reddit seemed to take everyone by storm with the meme stocks, GameStop and AMC and Bed Bath and Beyond and all of those. So now that it's its own IPO, what do you think? Could this turn into a meme stock? Give us 100% in a day?
Yeah, well, I mean, we'll see. I do need to disclose that I currently have a position in it. And right now it looks like it's still, in that early stage, right? I mean, at this point, it'll probably, if market shows it as a base, it'll probably just show as a first stage base, right? It's too late. There was no IPO base really to be had. I kind of like this pattern because it kind of looks like a cup with handle. And
I would kind of like almost say this looked very cup and handle-ish. Of course, it didn't work. It came down, and it probably would have been a more than a 7%, 8% drawdown there, but that then came right back and took that level.
Right, and it's now well, not today, I guess, but it did cross over that peak week that it had when it first started trading. But now, of course, it's getting rejected, and that's to be expected. We call that the turbulent zone. And it may create like another turbulent zone if it keeps going sideways and doesn't really perform, but that would be to be expected. This one I was really lucky on. I'll just share, Eve's really a pro at these, right when that first IPOs come out, and she's talked about it, I think, many times, where she looks for that U-turn. And so I kind of took a cue from her on this, and I drew a downward trend line from that peak day and kind of drew it there you go. You go down.
So how steep do you want?
Go to like 50, where your buy point would be 50, because that's pretty much where I bought it.
Okay.
And basically, and actually, I didn't draw that line. Now that I think about it, it was
I could see
there.
I could see doing 50 more like this.
That makes more sense.
Yeah.
We don't remember.
There's no second point to draw it off.
Yeah, there's no second point. So sorry about that, but you know how it is when you buy a stock and you're like, where did I buy that again?
Why did I do that?
Yeah. So
I'm glad I did, but why did I do it?
I saw this U-turn happening. I thought of Eve, and I'm like, okay, well, maybe at 50. And 50 is like a psychological level, right? 50. So I thought, well, I'm going to set a stop buy, and if it hits, then I'll get it. And of course, it hits like the day before earnings, and I'm like, oh no. But that was a good earnings report, and it's held that level since then. And, like we were pointing out, it kind of has that little bit of handle. It keeps shaking out every time it makes new highs. As you can see there, we're now on that third shakeout from now a new high above that turbulence zone. Mm-hmm. So, it looks promising. We'll have to wait and see. What comes to mind is that maybe it'll turn into a stair stepper. So something with the life cycle trade is that we kind of coined, what the different patterns look like, and the different patterns just help us identify what rules are the best ones to use or what to look for. So when they come back up and they create like this, a cup of handle, and if it doesn't undercut that whole structure, and keep basing. I know Chris Kessel doesn't like stair steppers, but maybe this one will stair step for us. We'll have to see.
Yeah. And to be fair, Chris Kessel doesn't like stair steppers because they're slow, but if you like slow, you want a stair stepper, right? It's, you want it to just consistently kind of build a higher base, a higher base, a higher base. And, you can make a lot of progress up if you're using stairs. Right. Nothing wrong with that. Now, you had basically a 40% plus gain on this. So you're not using MCP rules at this point.
I'm not using MCP rules. And so with an IPO, the other thing that I do, especially if I'm buying like within a few weeks of the new IPO, I'm only using like half a position size. So, and then I buy once, I sit still. I did try to buy it when it looked like it was breaking out of that handle, but I just sold that position. I was like, why am I doing that? Let's just stick with the core and we'll see how it plays out, because by nature, IPOs are so much more volatile. So if you're going to try them, that's what I would recommend. And that's what I do.
And so since you're starting with a half position, you are basically looking at, hey, is this something that down the road I can add to?
Right, exactly. If it were to now build what we would call a first mature base, and without an institutional due diligence phase, it looks like it's got the accumulation and all the things, then at that point, I would probably, consider adding to it for sure.
Yeah. Okay. Let's take a look at another one. Now, Hood, a lot of people were kind of pointing to the Bitcoin and, everything like that. But, Bitcoin hasn't been doing that great lately. And Hood is still doing just fine.
Yeah, let's look at the weekly chart. Okay, so clearly this one, we would call this one a late bloomer because it did have a little bit of a run up. I think I can see from your charts there.
Yep.
Yeah, just a little bit, and then it declined. If it had gone straight down and not even had any type of run, we would have called it a pump and dump.
Yeah.
In which Facebook was a classic pump and dump way back when it IPO'd.
But I'm just going to go there real quick just to kind of show what that looked like.
Sure.
Right here.
Yes.
And then it was a year and a half before, and it was earnings, right? When it came out with the earnings, that said, hey, we can monetize this thing. That was when it changed everything. But okay, back to Hood.
Yeah. So back to Hood. So we call this, what it's in now is an institutional due diligence phase. So those consolidations that have been happening there sideways. Yeah, exactly. We're looking for our first mature base, and you can have multiple bases, which in this case, it has had multiple bases, and it's only this very last one that got a little bit tighter, which we like, right? We like it when the bases get tighter, and maybe that shows a character change, which so far looks like it's been doing. And I need to disclose I have a position in this as well. I forgot to say that.
Yeah. So just some numbers here. This consolidation, this big one was 41% depth.
Right.
This one was 40%. This one was 23%. And then this one was 21%. And look at that. We have some 3 weeks tight in there too.
Right. So even right now, it looks actionable for a potential secondary buy point, or if you weren't in it already, you could maybe try some. But there is risk because you have this overhead resistance. And now granted, it is more than a year and a half away, but I still find that it still plays a part. I think there's some psychology in there that, keeps it from just going to the moon kind of thing. So
especially with something like, I think Hood was, a lot of, especially the younger generation, it was something that was really on their radars. So you got to imagine that there's people that, maybe stuck with it this whole time and are going to be selling, even though, again, we usually think of it as, you know, if you didn't get worn out or scared out with this, then you're probably a long-term holder.
Right.
You know, yeah, this will be an interesting one to see how that plays out.
And so you highlighted that first stage base, and you know, it looked really good. And so I think, you know, with the knowledge that, okay, it's not going to be all-time highs, but it is progressing out of that initial area where it was, that, you know, there's room for some upside.
Mm-hmm. And would you be looking at this tighter base here, the 23% down here, or do you kind of say, oh, well, this was all so muddy over here, you're looking at this 21% base, cut base up here?
No, when I screen for stocks over the weekend, I'm looking for that first stage base, that tighter base. So the deeper ones, like, I won't usually buy those. I mean, I have tried them. I mean, Twilio was an example where I tried it multiple times before it finally worked. But for Hood, I did not do that. And once I saw that tighter base, I was like, okay, maybe this one could go. And I really had to, like, make sure I didn't have a bias, because I had a little bit of a bias on it just based on some past news of it from, you know, years ago about the way that they disclose their information.
Right.
So it'll be interesting to see what happens.
Mm-hmm. And let's go ahead and wrap it up with semiconductor besides Nvidia. This is ARM Holdings, and this is kind of an interesting one because, yes, you know, we have an IPO, so it has that element. But I remember trading ARM Holdings in the 90s. You know, it went under the ticker symbol AR. What was it? ARMHY back then. It's from the United Kingdom. So yeah, this was one that we were familiar with. It's just we haven't seen it for a long time on our stock charts.
Right. And, you know, even I talked about this one in January of this year when we were at IBD Live, the IPO sisters, when we were both on at the same time. And this is one has done very well since then. And we were both buying it in that first stage base. Oh, and I need to disclose, I have a position in this one too.
Yeah.
But I sold it when it declined from, right there, you know, and I thought for sure it was going to go into a long institutional due diligence phase, because based on the research, like that was a clear signal that the IPO advanced phase, which is what we would call that initial run, was done. So the fact that it's come back is just kind of blown me away. And so maybe this is going to be a stair stepper, because if it doesn't have that big, long due diligence phase, and that's what stair steppers are. Stair steppers don't have institutional due diligence phases. They just keep going. So
where were you getting back in?
Well, let's go to the daily chart. That'll be the best way to show it. And then just let's draw a trend line from that high. Yep. Yeah. So basically that bar right there, I didn't buy it on that day. I
think Leaderboard might have been buying it on that day, putting it on Leaderboard that day.
So I didn't buy it on that day, but then the next day or the next day after that, where it had those two nice little tight bars, that's where I was buying it. So luckily it didn't keep advancing, and it gave me an opportunity to get in, because it really took me off guard. I was like, wait, what? It's back? It really is going to make it? So we'll see.
And now you've got about a 50% gain in this, you know, in a very short period of time. So how do you handle this going forward? What category do you put it in?
Well, you know, from just the story of it, I want to consider it a long-term hold. And if I still had those shares from the first base, I mean, for sure it would be in that category. But we're just going to have to see how it responds. You know, I'm not at 100% yet. And so we'll just have to wait and see. Yeah.
Now, one more thing on this one, though. This was not a tight consolidation. This was a 48% gap here. So what are you doing, Kathy? Are you breaking your rules? What's going on?
Oh, well, I didn't say that a certain percentage. I mean, I sold it and then I bought it again, right? So maybe I didn't understand your question. But
no. So you were saying that you were looking for tight consolidation. So what kind of allowed you to take the leap of faith on this one, despite the fact that you were looking at a 48% correction in this base that it did?
Well, it broke the trend line.
And it's just as simple as that.
It's just as simple as that. And at the same time that it broke that trend line, it also was up above that consolidation. And then
the one back here.
No, just that little bitty one,
Just little
right?
one. Okay.
Yeah, just right in there, and it went back over the 50-day line at the same time.
Yeah.
So you have all three of those things, like 3-for-1 kind of situation. And I always like it when, you know, if something goes above a moving average line and then it also breaks the psychological level, or it's also over this. So the more things you can get in the one, I think are just more signs that it might work.
Mm-hmm. And yeah, that was one of the things I was kind of looking at too. It's, you know, yes, this was a 48% depth, but you did have your tight area here. You know, maybe it wasn't long enough, but you did have something that you know, kind of suggested that it was kind of turning a corner, and you know, multiple things at the same time. Well, Kathy, it was great having you on. Always a pleasure. And next time I'm in Denver, I'll have to come visit you. I know I say that every time, but one of these times it'll be for real.
All right, we'll go on a hike. We'll get you moving.
Yeah. Well, if I can handle the altitude, we'll I'll train for it a little bit.
I'll keep you in the lower areas. It'll be good.
It's been a while since I've done Pikes Peak. That was what, 30 years ago or something.
Oh, right. Yeah.
Yeah. But very good. Well, hey, it was a pleasure having you on, Kathy. Thank you so much for sharing your knowledge with folks. And again, folks can also get that Lifecycle Trade book on Amazon. It's a good one to read. That's going to wrap it up for us today. Don't forget to make time for us next week. I know I said last week that David Ryan was going to be on today, but Kathy Donnelly came in because he had a little thing he had to get taken care of. But David Ryan will be with us next week. 3-time U.S. investing champion, protege of William O'Neill, portfolio manager for Bill for a number of years. And also he was running the New America Fund for Bill and his own hedge fund for a while. You can also see him on IBD Live, but it's going to be great to talk to him next week. So hope you join us for that. Thanks a lot for watching this week. We'll see you next time.